code was created for business owners. If I have rental property, I'm a business owner. We specialize in helping high earning W-2 employees get the most back from a tax standpoint. You don't do that by doing a 401k. It helps. But if I got $32,000, let's say I'm 30 years old. I get to put $25,000 in my 401k, which I want you to do. $25,000 to 401k, I make $100,000. My taxable income goes from $100,000 to $75,000. That feels good. That does feel good. But what if I use that $25,000 into a rental house? Now I get to write off all the repairs and everything associated. Probably writing off of between $40,000 to $60,000 that first year. So now from a taxation standpoint, I go from $100,000 to maybe $40,000. A lot less I don't pay taxes on. And if I do what we call a cost segregation study, where I have my depreciation not over 27 years, but over 5 years, I probably get all that money back in 2 years. So that $300,000 house, I get a $60,000 write-off for the next 5 years. That's a lot of money I can use to pay down the mortgage or build my real estate empire. So that is just a way for you to click and be clickbaited and help them drive up the algorithm.
What's your thoughts on HSA?
HSA is great. I have a story. They call it mommy makeovers. We call it a BBL. 4 years ago, I had a clients, right? Husband and wife, a stay-at-home mom. He was working, he's an engineer, actually, software engineer in Houston. They had their third child, and we just wanted to find a way to kind of get more taxable decreases, right? So, well, let's do an HSA. Because with HSA, you can put up to $8,300 if you're married, or $4,100 if you're single. It is the trifecta of taxes. I put money in, it's a tax deduction. So if I make $100,000, I put $8,000 in the HSA, I'm taxed on $92,000, not on $100,000. So tax deduction. It grows tax deferred. So when the money grows, I don't pay taxes as it's growing. But if it's used for any medication, surgeries, elective or not elective, I get to take it out all tax-free. Over a 3-year time period, they put in basically $24,000. It grew to $31,000. They took out $31,000 tax-free. And his wife got a mommy makeover or a BBL. Happy wife, happy life. Happy house is a happy spouse. So they was able to use the tax code to their advantage. They got over 3 years, $24,000 of tax deductions. And then they had $7,000 of tax-free growth. They took it out, didn't pay taxes on it. So HSA is great to have.
That's good, because a lot of people don't know about HSAs. Actually, I never discovered HSAs till about maybe, about 5 years ago. My accountant's like, hey, why don't you do an HSA? I said, what the heck is an HSA? And I had to research it. And at the time I was single. Now I'm married. So, we put it in together, but it's one of those best kept secrets in the financial. Most people in the financial world, most people don't know it. And there's a lot of companies that don't handle HSAs, like Edward Jones, I don't think does HSAs. I think most people go to like Fidelity or something like that, or
yeah. And so again, you got to follow the money, right? It's like, walk to the Wizard of Oz, follow the Yellow Brick Road. You got to follow the money. So to your point, a lot of financial institutions don't offer it, so their financial advisors or their certified financial planners aren't pushing it. Like again, as a certified financial planner that has a very large client base that leans in from a tax standpoint, like, we want you to save money, and when you save more money, you make more money, you increase your net worth. Like our motto is we want to decrease your tax liability and increase your net worth. So yes, if we put our money in the HSA up to $8,000, we get the same write-offs as it going to a 401k. We can invest in the same things. So we're investing money, but unlike a 401k, and I love 401ks. I built my business on 401k rollover. So we're not anti-401k, but just from a tax standpoint, the first $8,000 might be better to put into the HSA, because if we can take it out, we all going to have something happen medically, right? Our kid sprains their ankle, right? Got to get a cash. That's a $4,000 bill. HSA pays for that tax-free before age 59 and a half, not like a 401k. So it's so many advantages. So the conversation we have now, to have an HSA account, you have to have a high deductible health insurance plan. So some people don't offer that. They offer PPOs, HMOs. So not all employers offer that. But if they do offer that, we typically have a conversation. Let's put the full $4,100 or the full $8,300 first before we do the 401k after our match. You want to do it your match, right? Because it's free money. If you don't do your company match in your 401k, in the words of DJ Khaled, you're playing yourself, right? You want to do that because it's free money that you never get back. But besides that, anything extra going into our retirement plan, we should be looking at our HSA, because unlike the 401k where we might penalize and we take the money out, we have to pay taxes. HSA, we don't pay taxes, and everybody's going to have a medical event. It happens. It's life.
And speaking about 401k, what a lot of people don't know is that when you're self-employed, you can have an owner K if you don't have any employees or such, and you can actually, as self-employed, you can match your own deposits. So if you take so much out a month and whatever the allotted is for the year, and you put it in, but then your company can match or add to it, can it?
Yep. Owner K, solo K. So as a small business employee, kind of two things you can do. You can do like the 401k route, which is with ERISA, right? So basically ERISA is the government kind of telling you what you can do. Not saying it's a bad thing, but you have to pay for a 401k. Or you can do a SEP IRA, SEP IRA. So with a SEP IRA, we'll start with the SEP IRA first, because you have more control. You can't put as much in, but you have more control as a employer. So as a SEP IRA, you can put up to $69,000 a year. Now with the SEP IRA, the up to $69,000 a year, or 25% of your money that comes in. So let's say my business made $100,000. Right, I can do up to $25,000 a year because it's 25%. It's what's either lower, not higher. It's not like my company makes $100,000, I could do $69,000. That's on the higher end. You're going to do whatever's lower up to $69,000. But then the good thing about the SEP IRA, you have more control. So let's say you think you're going to do $25,000, which is 25%, but you do less. Like you're not holding to a number like you are with the solo 401k. So you have more control. If you have a not so good year, or a year is not as good, you can do less. So that's the SEP IRA. The solo 401k or the owner 401k that you're talking about, you can actually put up to $167,000 in that if you structure things from a solo 401k, then a profit share where you're sharing the profits, right? So you can do actually up to $167,000 a year in that. That is huge. If I'm making $300,000 and I put up to $167,000, my tax liability is now what, $140,000? Me paying tax on $140,000, not on $300,000. Then of course you're paying yourself a salary that decreases your tax liability. You're an S corp, right? So then the other amount that's in the business, you get the right 20% off QBI because of the big beautiful bill. 20% QBI. So yes, so an owner 401k or a solo 401k allows you to really pay yourself in your 401k and allows you to decrease your tax liability. But like I said, it does go through ERISA. So it is rules you got to pay. You got to pay a 401k company to adhere by those rules. So it's going to cost you more out your pocket. But if you're putting in more than $69,000, then yes, not a recommendation, but information, a solo 401k or owner 401k, might be the way to go.